Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy, live streaming from TicketTacker. This is the early morning update for precious metals for January 14th, 2021. We're going to move right into the platform, TicketTacker platform here, and take a look at the metals here with gold trading last at 1842.70. Fast market here. It's been in a pretty volatile period here since overnight. Silver 25.54. It's about unchanged to slightly down about 3-4 cents. What I would like to do on this segment here is to take a look at some of the fundamentals that are overriding the market this morning, creating this volatility here. And we'll take a look at yesterday's action and some of the fundamentals that we're dealing with in the market, and we'll take a look and see what the VCPMI is telling us for today's trading for the rest of the week. And if we have a chance, we can take a look in terms of what the rest of the month looks like. The precious metals settled higher on dovish central bank comments. February gold on Wednesday closed up 10.70, up 0.58%, and March silver closed up 13.7 cents, up about 0.54%. The gold and silver on Wednesday settled moderately higher on dovish comments from global central bank officials. Precious metals also gained on increased safe haven demand after the U.S. reported a number of COVID deaths on Tuesday. Gains in metals prices were limited Wednesday by a rally in stocks and a strong dollar. Wednesday's global economic data was bearish for gold, but supportive for industrial metals demand and silver prices. The Eurozone November industrial production rose plus 2.5% month-to-month, stronger than expectations of plus 0.2% month-to-month, and the biggest increase in 4 months. Also, Japan December machine tools orders rose 8.7% year-to-year, the biggest increase in 2.25 years. Dovish Fed comments on Wednesday were supportive for precious metals. Fed Governor Brainard said the economy is far away from our goals in terms of both employment and inflation, and that the current pace of bond purchases will remain appropriate for quite some time. Also, St. Louis Fed President Bullard said the Fed must regain credibility, that it will hit its 2% inflation target, and we are going to be less preemptive than we would have been in previous decades. We are going to let inflation go over target. Just this comment alone is pretty bullish for precious metals here. Comments on Wednesday from ECB Governing Council member Villeroy de Galau were dovish for ECB policy and supportive for precious metals when he said, the ECB remains clearly committed to its 2% inflation target, and to achieve this, we will maintain favorable monetary conditions for as long as necessary. I just want to point out that inflation is running well above 2%, according to shadow stats, by including some of the food sectors that they have eliminated out of the formula that they get, which is that inflation is under 2%. The real inflation rate is running more like about 10%, according to shadow stats. So Wednesday's U.S. consumer price data showed slack price pressures that are negative for gold. Demand as hedge against inflation. The U.S. This is the misconception that they want you to believe as a self-directed individual and trader that there is no inflation, that you don't need to worry about that because they got it under control. We'll get into this a little more specifically, but the real data that we use indicates the contrary to what these government figures are indicating. So as a self-directed trader, what I'm showing you here is what the media, basically how the media is looking at this, based on some of the government figures that are produced by our government that want us to see, to believe that there's no inflation. Everything is under control, just like the debt, the bubble that is right now at the risk of imploding. The bond market right now has the biggest risk as an asset if, according to their statistics, inflation exceeds 2%. And then, of course, the question is, what happens if inflation exceeds 2%? That's the question mark. And I believe they have it all set up. They have it all figured out that, according to their statistics, if inflation exceeds 2% in their data, they're going to control the yield curve. And that means basically raising a cap, a limit on long-term interest rates, that they will not raise interest rates regardless of the level of inflation. And I think what they're planning on doing here I don't think this is what they're planning on doing. I think this is what the market is basically aiming for, is that we need inflation in the system to get out of this implosion, to get out of this recession. Some way, somehow, they want to create inflation, which is really the reason why all this stimulus is coming into the market. The other side, basically, of what's affecting the gold market here is that gold has support from worsening COVID pandemic, which is dovish for central bank policies. They got to maintain low interest rates. The economy is on lockdown, basically. So there's no economic activity or productivity. However, the pandemic is forcing countries to tighten their lockdowns, which is negative for economic growth and industrial metals demand and bearish for silver prices. From an industrial point of view, but the metals, and this is one of the reasons why I personally trade gold, silver. It's beyond a commodity because they have a number of different applications that are economic, industrial, and pretty much as a risk and safe haven in times of economic chaos, particularly when we are threatened with the devaluation, basically, of its underlying asset in terms of the U.S. currency, which is the U.S. world's reserve currency. And anything that happens, obviously, to the U.S. currency, if it sneezes, Europe, is going to catch a cold. The U.S. reported a record of 4,610 COVID deaths on Tuesday. Also, the UK on Wednesday reported a record of 3,363 people on mechanical ventilators due to COVID. In addition, Japan expanded its COVID state of emergency beyond the Tokyo region to 7 more prefectures, encompassing an area that accounts for more than half of its economy globally. COVID infections have risen about 92,140 million, and deaths have exceeded 1.973 million. Precious metals have underlying support from expectations that the Democratic-controlled Congress will pass new deficit-expanding fiscal stimulus measures. Last Friday, President-elect Biden said his stimulus package price tag would be high and in the trillions of dollars. President-elect Biden said that he plans to release details of his stimulus plans this Thursday. So this is what's bringing in the volatility today. And, he said it himself, President-elect Biden, high and in the trillions of dollars. Now, what I think is beginning to happen here as we make the transformation of leadership, you might say, that Biden is probably going to do the opposite of the previous administration in terms of disclosure. And I think it's to the advantage of the administration to disclose all of these things right up front so that it's contrast to what was previously done, and we can deal with the reality of the situation, and the markets can begin to recalibrate and to adjust to basically the fact that this stimulus is destroying the US dollar long term. Every time they print a dollar, it takes off an edge on the US dollar strength, on its purchasing power. And the thing that I recognize here just as a self-directed trader in terms of the cause and effect of this, this not only long-term is going to have a lot of implications here in terms of our lifestyle, in terms of a cost for goods and services. I've already accepted the fact that we're running inflation at about maybe 10% and maybe higher. And it's a matter of the markets beginning to recognize that essentially the real economy is getting overheated. And this is good for the Fed. This is what they want to see. This is why they're pumping all this money into the system right now, providing tremendous liquidity for investors to take this liquidity and put it back into the system, put it back into the economy, and we can begin to see some stability economically. Safe haven demand and dovish central bank expectations have sparked fund buy-in of precious metals in recent months. However, long liquidation has set in after long positions in ETFs fell to a 5.5-month low on December 22nd, down from October record high of 3,459 metric tons, data since 2002. Also, long silver positions in ETFs fell to 3.25-month low on November 30th, down from the mid-November record high of 904,165 million troy ounces. Let's take a look and see. Basically, right here is one of the reasons why I believe this is a great time to be looking and adding to the precious metals markets here. If you're a long-term trader, for example, you want to buy into this when everybody's dumping. When the funds, the statistics here show, obviously, they have liquidated a great number of contracts long. So you want that as a self-directed trader, basically, because that is when the market makes the low, usually when everybody that wants to get out gets out, the bus stops, and everybody gets in that wants to go long-term. So from a fundamental point of view, I think I'm looking at the fundamentals supporting prices down here, and not only that, but the sentiment of the market. If everybody is getting out of the gold market, probably is the best thing, especially at these levels. Because if we go into the market right now and take a look at where we are here, we are trading last at 1841.42. The market earlier this morning made a low of 1826.27 and found an incredible amount of buying. If you look at this bar from the low that we made of 1826 to pretty much close at 1838. And this was within the same time frame, within the same bar. Now, what you're looking at is the buy one level today to be 1837, the buy two level to be 1828. And this action here basically confirms that the market met the targets activated by the trend, the bearish trend momentum trading below 1850, activating the short bearish trend momentum the second time here. The first time was here. It came back down. It went back up to test it. And when it failed the second time, you can see they unloaded supply. And there was a lot of supply here from 1850 all the way down, to 2860. That was a $20 move really fast, easily. But it found buyers right into the area where the VCPMI is telling you in blue that is the highest probability where you are going to see buyers congregate. Value. This is value. This is undervalue right now for day traders. The 28 to 37 area is undervalued. The fact that the market reverted right back up and close above it here activated a buy trigger. Automatically, it identifies the target above, which is the mean, as they target, and the signal here came in at about 7:15 p.m. last night. excuse me. One of the things that I've noticed here with the gold market is that there is a lot of trading that is done on the Globex. Where ordinarily, if you're not trading overnight, U.S. traders, you're going to miss this move. But it did test the lows and reverted right back up, found buyers, met the target at 6:30 a.m. this morning, and activated again a bearish trend sentiment. So the 1837 is a live target for the day, for the rest of the day. And so we're waiting to see if we come down and test this level again of 1837 to activate another trigger point, or it's going to close above or through 1850 and go up to the sell one level of 1858, which is the sell one level the VCPMI identifies for us today. So the signal for today already has been completed, and what we want to see is let the market basically do a little bit of trading here. What I want to take a look at is the daily charts that indicate the market is holding this Fibonacci trend line support, which converges pretty much with the VCPMI at about 1828. It also converges with the Bollinger Band lower band, which is an extreme, another probability model, another probability indicator that down here, more than likely, you're looking at an oversold condition. And what you're looking at here is this bar today coming down, completing the 1828 target, 1837 daily, and we're trading at 1842. Now, what we want to see is close, if possible, above 1850, and that activates the levels above daily of 1858, 1871. Now, on the right side of the chart, we're looking at the monthly average of 1864 and the weekly average of 1880. So we've identified a good area of buy-in, confirmation, longs came in, but the triggers were activated on the long side. The target, the initial target, the daily initial target was completed. 1864 is the monthly average price, and that is integrating itself and trading between the daily area of distribution of supply of 1858 to 1871, which is resistance, which is where the area where the VCPMI tells you possibly that this is a high probability area to identify supply come into the market or sellers to come into the market. Now, what's going to determine the direction basically is how the exchange of that supply is traded up here, and whether there are more buyers that would take all the selling pressure that we get when we get these big bars, which is all central bank selling. All central bank. This is the kind of, I believe, confirmation of manipulation in this market by large commercials that can finance record level of naked short positions in the futures markets and collapse the price, as you see here on these bars. The thing that is really amazing is that regardless of these attacks that you see here, the market comes down and completes the technical patterns to a T. it came down here regardless of what was the driven force, so to speak, that drove the price down. If we look at the probability model, and almost, we include, let's say, Fibonacci retracements, the market came down right into a 50% Fibonacci retracement at 1771. And established the low from the recent high that we made, an all-time high that we made of 2089. Using that measurement, now we get this trend line, Fibonacci fan lines, which tells us basically the resistance of the market, the levels that we could see resistance in. Here we see the relationship to these levels, and when it does reach, if it fails, it's a pretty high probability signal. And when it comes down into this area, then I'm prepared because I got my numbers, I got my code, in terms of the action of the market. And so I recommended everybody to go long here that thought they missed the gold market. Long term, this was an area to accumulate. This is another area to accumulate. And this, where we are right now, is a major area to accumulate. So now we're looking at about 1840, 1850 as a major area of accumulation. So and this is not you might say, listening to the chatter. This is allowing for the math of the market to identify this probability factor that integrates itself within other, more common technical indicators used. They serve for me confirmation validity in terms of the relationship to where they are in price to the VCPMI, which is really a momentum indicator. It's a momentum indicator. It identifies the extreme levels of the supply and demand above the market or below the market for very specific sessions. We've seemed to come down to a level of support. So what I want to do is just allow for the market to trade here as we take a look at some of this other stuff. The silver market has also completed the target, and we seem to be increasing the volatility of the silver market as well. But it did complete the first target, and you can see here basically that upon completion of the target, the market reverts. And, it could revert back down to the mean. If we get through the sell one level and close in about 25.65 for multiple positions, basically it activates the level above. And this is where pretty much the VCPMI tells you, if you get up here, you don't need to be shorting here because you're shorting buy-in. You need to buy up here, I should say, above this level, because buying up here gives you a very low probability. If the short signals begin to activate, 90% probabilities from here, 95% from sell 2, even though the market can close above this level, it can still run up to the second level. And so if you look into the multiples, for example, and you want to take a risk, this is the area where you want to concentrate and see whether you're going to accumulate. Everything depends upon your profile and your pretty much profile for risk and money management. It's a pretty quiet day. With obviously a bullish buyers, as the expectations are for this stimulus package to be announced. And that's pretty much what the market is hanging on. I think the equity market is hanging on to that as well. And we want to see how big it is. And I think this announcement is going to give us an indication of how aggressive this administration is going to be with this stimulus for the rest of the year. But rest assured that this is just the beginning, and the numbers are staggering that are needed to be implemented into the economy to, first of all, prevent, as I said, an implosion, and also to be able to create some kind of inflation, which is what they want to see. They don't want to see this continuing to implode. And we're running out of ammunition when you really think about it. Interest rates are at near 0%. If you factor in inflation, pretty much we're running on negative rates. And if we use the real inflation, we are deep in the hole in terms of negative rates. This is where I find an issue with some of the numbers that I research on my own, so to speak, in terms of the real numbers, the real math of the market, and what this government wants you to believe or to see according to their formulas. And what I'm finding is great discrepancies in terms of what the real economy is saying and what those numbers are indicating. For the life of me, I don't understand how they can say inflation is below 2% when, if you include energy and food prices that are skyrocketing right now, the CPI is month to month is indicating that we have an increase coming up, but they underplaying, I believe, tremendously the fact that inflation is already here. And the reason why I believe it's important for them to manipulate this curve is because they don't have many choices when you really think about it. And the worst thing that can happen right now is that interest rates go up. One of the reasons why the gold market got hit last week here is because the 10-year note went above 1%. And got up on, I think, 1.25%. And that's not good for the Feds. It's not good for the debt that continues to pile up at record levels. And, so it's contradictory to allowing room for economic growth when you have pressure, supposedly because of inflation or an economic activity that essentially will demand higher interest rates in order to control it, so it won't get overheated. But I think they're going to allow inflation to run its course, and that means basically a severe adjustment in terms of prices here. Crude oil is headed towards $100 a barrel from negative 37 just a few months ago. So what this, to me, I believe is doing here is pretty much indicating, confirming that the commodity markets are alive and well. we take a look at soybeans, 1436 was the high. It was $8 back in March. 808, 1436 for soybeans, new highs. Corn, 528, 541 is the high. $3, the low was $3 back in March, April. And this is just the beginning of the cost of food. This is just the beginning. Because what you're going to see is an increase across the board for commodity prices. So therefore, how, because you can't be in every commodity, in my opinion, it's very difficult to trade, for me anyway, more than, 3 or 4 contracts actively, unless I use the robot, to execute it. But in terms of me being able to have the control and the pretty much the maneuver, the ability, ability for me to be flexible in terms of the application of the intelligence, as opposed to a one-dimensional, you might say, indication, which is really what the automation does. The automation gives you a signal based on one multiple. And it tells you buy or sell based on one multiple. It doesn't tell you, pretty much how to expand that intelligence into other derivatives. And this is what I say to my traders here in my room, my private trading room, that once you understand the logic of the signal, which is directional in a sense, and then we get a signal that is a profound signal, like we're looking at in terms of the gold market. Then based upon your skills and ability, you can execute and apply the intelligence exponentially in some of the derivatives that are available in the sector, within the sector. And because there are thousands of instruments that are available within the sector, you don't need to necessarily just be trading, the futures. You can take the signal, the intelligence of the signal, which is directional in a sense. And if we're looking at a directional move unfolding, developing here, you can begin to build a portfolio which is diversified. You can go into stocks, you can go into ETFs, you can go into options. There are many, many ways for you to benefit and apply the artificial intelligence, so to speak, that tells you we're beginning a trend. And that's where, pretty much the big money is made in trading commodities here. So this is fantastic because these commodities have been clobbered, obviously, over the past 10 years. And now they're becoming alive. And the moves in commodities do not compare to anything in terms of volatility, except maybe, to the volatility of the futures contract trade that trades the indices, for example, which is tremendously volatile. But from a trading point of view, a consistent, you might say, way of trading the market, I focus on the gold market because the gold market is the beneficiary of everything that I just mentioned fundamentally. It's the beneficiary of inflation. It's the beneficiary of political unrest, economic unrest, and unprecedented political situations that can affect the basis, you might say, of the U.S. dollar as the world's reserve currency, such as wars or attacks, you might say, on U.S. territory. So it's an exciting time because, number one, the gold market has been completely ignored. It's been manipulated. It does not reflect the full value of the relationship, for example, to the stock market, to the Dow Jones. On my live roundtable interview yesterday, I made the comparison that back in 1981, when I was looking at the Dow Jones and gold, they were pretty much at 1-to-1 par at the time. And now we're looking at the other side of the coin at this point, which is tremendously overdone. And the question is, whether the stock market is going to adjust or revert down to its mean, or the gold market is going to catch up to the value of the Dow Jones at 30,000. So, one of the questions is that relationship going to be 1-to-1 once again? And therefore, gold could go to 30,000, or, adjust that relationship to 1-to-1, but you're still talking gold way behind that needs to catch up just on that relationship. You take the obviously the price of gold and you measure it to the debt to the GDP ratio, and it's completely skewed. And the thing is that I don't think anybody knows really what the real price of gold is. So now you got Bitcoin at 40,000, and that spread to gold is just going way, way into the stratosphere. The fact that this is being created, this what I call anomaly, for example, because Bitcoin is not a currency. It carries tremendous additional risks. People that think that they're coming out of the system, putting their money into Bitcoin, and are pretty much out of the grid, are totally under the misconception that they're safe, because they're going from one regulated system into another unregulated system that's primarily subject to technology. And so what I'm hearing is that there are people out there that have made millions of dollars, hundreds of millions of dollars in Bitcoin, but they can't get in their wallet. So that's one of the risks. And the other is obviously regulation, which I think is on the horizon. There will be regulation because the government has seen the public demand for virtual currencies is tremendous. But in order for them to be in that sphere, so to speak, in that world, they got to be the ones to regulate it. So I expect that we're going to get regulation implemented, particularly if we see an issuance of virtual currencies by our own central banks, which is, I believe, the next dimension that we're headed, is to create a virtual currency for a virtual economy, obviously, that's already running on its own. And it's been running on its own since March. So coming back to the gold market here, what you're looking at is a correction in the market here that is beginning to identify. We're getting an area where buyers are being accumulated, buying is being accumulated. And if we get through 1880, we're going to take off. There's hardly any resistance to the upside. This is all air up here, all the way up to 1932 and all the way up to 2015, which is the sell 2 weekly level, which is in place for the rest of the week. Very exciting times commodities are back in style. And I think very much like the 70s, because we are beginning to see the beast unleashed called inflation. Let's watch the market a little bit here and see where it wants to go here for the rest of the day. We made a high of $42,730 yesterday on Bitcoin. And the way that we are trading Bitcoin is through GBTC for the reasons that I mentioned, running a risk of technology or forgetting your password. And so what you see here is GBTC, which is the Grayscale Bitcoin Investment Trust, which is a registered ETF by the exchange that you can follow and trade Bitcoin. You don't need a wallet. It's a regulated instrument, and you run the same risks, in trading Bitcoin, except that you don't run the risks of forgetting your passwords. You don't need a password. And as a trader, that's what I'm interested in, is the ability to be able to get in and out quickly and be liquid and have no obstacles in pulling my money out. But this is an incredible instrument as far as volatility is concerned. And what you see here is the cause and effect of the psychology or the sentiment of people that are trying to get away from the US dollar. It's highly speculative, but it's not a currency. It's a virtual asset. So we're waiting for the announcement of the Feds as far as the stimulus is concerned, and engaging what kind of a number we're talking about. The number that I hear is about $5 trillion, which is a big number. $5 additional trillion. Wow, it's just amazing. I've lost track of the number of trillions and trillions that they're talking about. What I'm looking for is the opportunity the market is giving me and the setup so that I can follow that sentiment or counter trend that sentiment. It's all about, making money here. It's all about producing liquidity, allowing for the market to give you that opportunity to do that. And that's what's great about this business is that I think this is one of the last horizons, you might say, of a free market enterprise. The fact that you can take, if you choose to take a risk, that you have the ability to, according to that risk, profit as well. The greater the risk, the greater the profit. We're taking a look at the gold market here. What looks to be a reversal, a key reversal day unfolding. So it's doing the right thing at the right levels. And all we got to do is just follow the market. We day traded the market earlier by the signal that was activated at the buy one level, and then we sold it just at this price level here, and we took profits, a little bit of profit on one of them, and I think we want to maybe just go flat on the balance if you have a position open. And just book the profits. So we produced about $1,345 here for the day on this day trade. And that's a nice day trade. $18.45.20 last. And I actively work with my trading, my traders here in the live trading room, constantly updating, recommending signals here to go long at 1838, pretty much how to follow it. And I'm actively trading in this room along with my live traders, which is basically what I'm doing is showing how I'm applying this in a live account. So I'm pretty open in my trading room in showing how I'm doing this. Then it's pretty much up to again, like I say, you as an individual trader, based on your profile, how you approach this this information and execute it. But I've been doing now approximately about 250 live hours of live streaming, trading live here in the last couple of years, and I'm really excited about the results that we've been getting by applying the same intelligence. The silver market seems to be taking the leadership up here, following the gold. But I think gold has got a lot of catching to do, and I think we're going to possibly start to see some incredible volatility here to the upside. So prepare for volatility. Don't over margin yourself. Don't get greedy. Create a strategy that, regardless of the shakeouts that we see in the market, that you're not gonna panic, that you can hold on to it, because I think we're gonna begin to see some fast market to the upside, and I'm expecting an extremely high level of volatility here coming up. So let's watch the market here as it reacts to this news that is expected coming out from the Biden administration regarding stimulus. Fasten your seatbelts. We're about to take off. This is the daily chart indicating that we potentially have a key reversal day building here. So if this market is able to close above 1850, it's going to put in the bullish trend momentum back in place daily. A close above 1864 will put the bullish trend momentum monthly, and a close above 1880 would be a breakout point of all of the three trends. And I think we're going to take off, and potentially we can reach that 2015 level rather quickly. Once again, ladies and gentlemen, thank you for the opportunity to share this incredible intelligence with you. I hope that you, every day you come here, become a better trader. Take care of yourself. I'll see you soon. Have a great day.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control here at Ticker Talker. And Steven, this is an amazing